Welcome to Theo Trade. My name is Jeff White, and in this video I want to talk a little bit about bottom fishing for stocks and bargain hunting for stocks. And specifically, I'm going to show you how you can do it a little bit better than maybe you've done it before, as well as hopefully help you to reduce your risk somewhat when you do want to pick up some shares which have fallen out of favor for a little while. And speaking of fallen out of favor, we've got a chart here of Chipotle Mexican Grill, CMG, which has certainly fallen out of favor in the last 2 to 3 months. And we've seen this thing really just work its way lower with lots of heavy downside volume. We've seen a number of distribution days where we get above average volume on declines in price. We have seen this thing tumble from the mid 700s to now sub $500. It has horrendous news flow. I don't know a soul who's eager to go out and eat Chipotle, no matter how good it used to taste. All of a sudden, you just can't seem to spell Chipotle without E. coli. And all of a sudden, the big question is, on traders' minds, is it time to jump in there and buy this thing? I don't know. I mean, let's first discuss this idea of bottom fishing a little bit further and kind of cover some points here that I think are very important. I mean, look, everyone likes getting a good deal, and traders are perhaps the people who epitomize that attitude more than anyone else out there. After all, we're the ones who are transacting almost constantly. We're buying and selling. Every time that we do so, it's at a price that we're willing to accept. In fact, if you're trading with limit orders, then you're naming your price. And getting a good deal is always fun. We all like that. I mean, we love discussing the great deals that we find on Black Friday or Cyber Monday, and whether it's the house that you live in or the car that you drive or the electronics that you use. I mean, buying things on sale is really the way to do it. However, when it does come to stocks, it can actually be a very different story. And the reason why is that while that shiny new tablet that you see at the retailer or on Amazon may be discounted off the regular price a significant amount, we kind of know that it's not going to fall beneath a certain threshold before they're sold out and they're gone. They're eventually going to create enough demand with those low prices that prices won't fall beneath that level. But with a stock, the fact of the matter is that it can just keep on drifting down, down, down into oblivion and into that dust known as Pennyland. And at that point, what you need is an absolute miracle to bring that thing back to life. Let's take BTU, for example. This thing just can't stop tripping over itself. And even with a reverse split back here of 1 share for 15 shares on September 30th of 2015, we've seen no positive effect in the share price. And there's many other stocks that are like this out there if you want to look for them, but this is just a good visual example of what can happen. So, it becomes really a tricky thing to go out and buy stocks when they're on sale. Maybe you love certain companies. Maybe, for example, you're a big Apple fan and you like everything that they create. Maybe you use a Mac and you have an iPad and there's an iPhone in your pocket. I mean, that's great. There's nothing wrong with having your favorites, but you've got to be really careful when you start to bargain hunt for stocks. So when you do, one thing to look out for is whether the stock is making fresh, new, longer-term lows. Okay, let's say just 52-week lows, for example. If that's the case, then it's obviously trending down. It has yet to locate enough buyers to produce some support. And when that's the case, it can be sort of like you're jumping out in front of a boulder as it rolls down a mountain and expecting not to get flattened. The fact is, it's gonna hurt. So instead, it can really help to just be able to wait for a stock to form some sort of a higher level of support as compared to the low. So let's turn to Wynn, for example. This Wynn Resorts, I mean, the best way to kind of buy after weakness versus into weakness is going to look something a little bit more like this. You're not trying to step out in front of all this red. What you want to instead see is a stock that's maybe worked its way lower and then has rebounded and then established some higher level of some support here on the chart compared to where it created the low. So what you're getting here is some visual that there is some demand, there is some new support here that's all of a sudden showing that something is a little bit different technically and in terms of the sentiment out there. So this Wynn, it trended lower for an extended period of time. If I change the time frame here, go back a couple of years, we can see that back here in March of 2014 was when this thing peaked, and it's actually been working its way lower since then. If I zoom back in a little bit closer to the 1 year chart, then obviously we've got that better visual for the low compared to this higher low that it's established in the last few weeks. So, I mean, it may not be done yet, but, and I'm not saying that it is done, but the fact is that it has changed character somewhat, and now it's lifted and moved laterally, and those two L's are very, very important. So the fact that this thing has also established some pretty well-defined resistance up here just beneath the $80 level also creates a new kind of a pivot for this thing potentially being able to work its way up here in the future. We'll have to see if that's the case, if it's able to produce that or not. But that would be able to open the door for a longer lasting recovery. So having this patience to wait for the storm to pass can really help to avoid some of that pain that comes from jumping out in front of downside momentum, where today's sale price may look somewhat appealing, but it may also be soon eclipsed by tomorrow's or next month's new low price. I mean, you'll find that if you pay attention that to that longer term time frame, then the deep price corrections that happen are rarely immediately followed by big strength. There might be an initial spike off the low, but generally speaking, you're going to see that this lateral type of movement like we're getting here in WIN as an example is pretty typical before a stock is able to start kind of finding its footing and working its way back up. Take, for example, Kohl's, KSS. We've seen that type of a move. This thing has trended lower. It's been moving laterally here for a number of weeks, and now it's starting to perk up a little bit in an attempt to make some new recovery highs, and that's the sign of something different. That's a good example of that taking place right now. So understanding that is going to help your expectations. It's going to help you hold that cash a little bit longer until it's a better time to put it to work. Getting impatient can cost a lot, so don't be overly eager to buy new 52-week lows. Now, another way to get long into weakness is to do it by way of selling puts. I mean, you're going to be learning a lot more here in depth on this in the future here at TheoTrade, but for now, I'm going to keep it high level and just explain that it's a great way to create a built-in discount on the stock right from the very beginning. And when you take this approach, it's also going to produce a little bit of cash flow right up front, and it's really best done when the stock is either in a trading range, meaning it's moving laterally, or it's starting to trend higher, where that bullish bias of a short put is going to be a little bit more easily confirmed with the price action should it continue in the same fashion. So, I mean, in the case of a trading range, let's take a look at something like this Michael Kors, K-O-R-S. And we're seeing that, I mean, this has been in a trading range right here. And this would be kind of a decent example of where you can kind of sell puts into weakness that hold above this support zone and then look to cover them on subsequent lifts higher within this range. And, I can just kind of outline this range pretty clearly. And, the stock has kind of been cycling back and forth between those two areas. You could get an example of a trend and kind of selling puts into short-term weakness in something like a CSIQ, where we've seen time after time this thing is creating higher lows on subsequent pullbacks, and that's offering some opportunities to sell puts into some minor weakness that does not disrupt or disturb or damage the trend that's in effect. And so that can really produce some nice results. So if we go back here to our CMG example, I mean, when you see something that looks like this, is it wise to bet on a turnaround and buy the weakness? Well, I mean, unless you have a crystal ball, then only time is going to tell. But it never hurts to recognize when price is still trending lower and support has neither been held nor established. So by that measure, it's still early. And maybe it turns the corner, but if it's like many other stocks, then after the correction runs its course, you're going to see price first stabilize before it really starts to run again. I'm Jeff White, and thanks for stopping by TheoTrade.